So friends, let us begin with a very important aspect of capital structure theories, that will be MM's arbitrage model. So please write up this heading, MM's arbitrage model, and then I take you ahead. And you know one thing, MM over here stands for Modigliani and Miller. So it is Modigliani and Miller's arbitrage model. So let us understand this whole model through an example that is given in question number 39. Let us first read this question. The following is the data regarding two companies X Limited and Y Limited belonging to the same equivalent risk class. We find the two companies data given in terms of number of equity shares, market price per share, 6% debentures, profit before interest. Then given, assume that the companies distribute all the profits after interest by way of dividend. Required, explain how an investor holding 10% of shares in company X Limited will be better off in switching his holdings to company Y Limited. Use MM approach. Alright friends, so let me explain you what exactly is to be done over here. So we are talking about Modigliani and Miller's arbitrage model. First of all, we have to understand that capital of a company, which can be composed of two components, debt and equity. The moment there is inclusion of debt, that kind of capital is called geared capital, and the company is termed as a levered company. So you are using financial leverage, means you are using debt as part of capital. I repeat, when a company is using debt as part of its capital, we say that company is using financial leverage, and we call that company as levered company. And when the company is a levered company, means the capital of that company is a geared capital. It includes debt. On the other side, there may be companies which do not have any debt in its capital, pure equity financing. So when debt is not forming part of your capital, when it is pure equity financing, we call such capital as ungeared capital, and such company is referred to as unlevered company. Now what happens when there is an investor who is a shareholder in a levered company, is willing to switch his investment to unlevered company? You need to be little careful, because directly comparison of the two will not work. There has to be certain adjustment. That is what explained by MM's arbitrage model. So before I deal with this particular scenario, let me give you a generalized concept. Assume that there are two companies A and B, both have same amount of capital, 2 crores each. Capital of A is 1 crore of debt and 1 crore of equity, and capital of B is fully 2 crores equity. Now if I want to be a 10% shareholder in company A, I have to invest 10% of 1 crore, that will be 10 lakh rupees in company A, to become its equity shareholder, 10% shareholder. However, same capital base of the other company, company B, if I have to invest into 10% equity of company B, I cannot do with that capital what I have invested over here, because company A is funded by debt also. That means if I am shareholder of company A, by investing 10% of 1 crore, that will be just 10 lakhs, I can be a 10% shareholder. With that 10 lakhs, if I want to be shareholder of company B, I will be just investing 10 lakhs out of 2 crores of capital. My investment will be just very small. It will be a 5% shareholding. But if I want to have 10% shareholding, I need to pump in more money. Why is this happening? Understand, a company which is unlevered company, means which is not using debt as part of its capital, what that company will have to do? It will have to rely on larger capital base of equity, means the equity investment will be big amount, because there is no debt, more equity has to be invested. So what will happen? if I have to compare profitability from company A against profitability with company B on my investment as a shareholder, I cannot compare it directly because one company is levered company, one company is unlevered company. It is implied that I will have to need more investments if I have to be 10% shareholder in that company, or I would make a bigger amount of money invested, then only I will be capable of holding some substantial number of shares in that company. So, what is the solution over here? The moment if I am shareholder of a levered company, if I am leaving its shareholding, actually speaking, whatever was the risk over there because of debt, I am getting rid of that risk. For example, I told you that 1 crore of debt was existing in company A. If I am selling the shares of company A, I am getting rid of proportionate burden of that 1 crore which was upon me. See, ultimately a shareholder, an equity shareholder is the owner of the company. If the company has debt, means that owner of that company will have that risk of debt. That risk to the extent of 10% will even fall upon me. If I am a shareholder of that company, that proportionate risk falls upon me. The moment I invest in company B, which is an unlevered company, I will be free from that risk. So what happens? Risk level because of financial leverage is changing, and therefore investment in company A cannot be compared directly with investment in company B. So I told you what is the solution. If I am selling the shares of company A and switching over my investment to company B, fact number 1, I will need more money to be shareholder of that company because that company is an unlevered company. It has a larger equity base. I will need more money to invest. From where should I arrange that more money? Simple thing is, if I am selling the shares of levered company, I am getting rid of the proportionate burden of that liability towards that debt. So, as per MM's model, what you need to do is that much proportion of borrowing as a shareholder, as an investor, I should borrow privately. That means I should borrow privately from banks or any other financing institutions. Mind it, we are still dealing with traditional capital structure theories which are backed with the assumption that any amount of borrowings I need, there will be no limitation, borrowings can be raised, and that too at the same interest rate which is prevailing in the market, one constant interest rate. So, if those borrowings were at 6%, if I am leaving the shareholding of company A, I am getting rid of that borrowing, but that much amount I should privately borrow, and then the sale proceeds from the shares of the company A, means whatever proceeds I have obtained by selling the shares of company A, that plus the personal amount of borrowings clubbed together, I should make the investment in company B. That will give me substantial capital base, and then I compare my old earnings with the new earnings and see whether I am better off or not. If I don't do this personal borrowings, what will happen is there will be no comparison between company A and company B because both are into different categories. One is levered company, another is unlevered company. So when you compare the earnings of the two companies from the viewpoint of an individual investor, my earning from company B, whatever I get, from that I will have to deduct the interest on those personal borrowings. Personal borrowings will be required no matter what you do. You will have to borrow that amount personally for two main reasons. Number one, to make the investment at equitable level in terms of the risk, and secondly, I will need more money always to become shareholder of an unlevered company, because unlevered company will always have a larger equity base. So guys, please understand one simple thing. When you have to switch over your investment from a levered company to unlevered company, there will be a procedure that you will have to follow. First of all, you work out EPS of both the companies and you look into, as an investor, how much I was earning from that levered company. Next thing what you do is, you as an investor sell all the shares of that levered company, but the moment you sell the shares, you will get money, of course. You also should raise personal borrowings, which is in proportion to the investor's borrowings which were with the levered company, so that the burden on the investor remains as it is. Then with this clubbed investment, as many shares as you can buy in that unlevered company you buy, number of shares that you have bought in that unlevered company will then be multiplied to EPS of that unlevered company to find your gross earnings. From that you subtract the interest on personal borrowings and you get the final amount of earnings now from the unlevered company. That earnings you compare with your older earnings. If the earnings are increasing, you are better off. If the earnings are declining, you are worse off. If the earnings remain at par, you are indifferent with switching over your investment from levered to unlevered or vice versa. So how to deal with this whole scenario in the context of this example, let me take you through the whole solution step by step. Carefully understand and note down everything, and if you have followed what I have just discussed with you, it will be taking no trouble for you to understand the solution ahead. So let us move ahead and draft the solution over here. As I told you, the first thing what you will do is calculation of EPS of both the companies. So in this example we have X Limited and Y Limited. X Limited is the levered company, Y Limited is an unlevered company. So you will subtract interest from X Limited's operating income, and what you get is earnings available to equity shareholders. Number of equity shares are more in case of Y Limited because I told you it is an unlevered company, it will require larger equity base, and the EPS of company X Limited is 0.16 and that of company Y is 0.12. So please write up this working first of all and then I take you ahead. Alright friends, if you have completed this EPS calculation, let us move ahead and write up the calculation and workings ahead. Net earnings of investor at present. So the total number of shares that the investor is holding in X Limited multiplied by EPS of X Limited. The total number of shares in X Limited is 90,000. Our investor is holding 10% shares. So it will be 10% of 90,000, that will be 9,000 shares multiplied by 0.16, that will be EPS of company X, and 1440 will be the present earnings of this equity shareholder at present from company X Limited. Please write up this working and then I take you ahead. Alright friends, so once you have completed this working, let us move ahead and continue writing the solution further. Third working note, calculation of total proceeds in the hands of the investor as per MM's arbitrage model. If the investor intends to switch over from levered company as an equity shareholder, then the investor should sell all the existing shares that are held in the levered company, and the investor should borrow an amount that is equal to borrowings of levered company into percentage of shareholding at the same interest rate at which the levered company has borrowed. So please write up this explanation and this content, and then I take you ahead. Alright friends, I am sure you would have finished writing this whole thing. Before I take you further, let me explain one thing over here. Please understand, our investor was a shareholder in company X Limited, which was a levered company. As per MM's arbitrage model, switching over of your investment from a levered company to unlevered company, one very important thing that you will have to do is create personal borrowings. So what will happen? If you could observe, the total borrowings of company X Limited was 60,000. Our investor was holding 10% shares in X Limited. So logically, 10% of 60,000, this investor is also having proportionate burden of that borrowing, which is 10% of 60,000. The moment this investor is selling the shares of X Limited, the investor is getting free from that burden. Now, with that burden and without that burden, if you are having two different situations, they are not comparable. You need to carry over that burden. If company Y Limited does not have any leverage, that leverage on proportionate basis, this investor should create upon himself. That is the idea of the model. Therefore, what now will be done? This investor will be selling all the shares of X Limited, point number one. The moment this is done, the proportionate burden of that borrowing, which is 10% of 60,000, our investor will get rid of that. So now what investor has to do? On personal basis, this investor will have to borrow 6,000 rupees. And from where you got the 6,000 rupees? 10% of the total borrowings of company X Limited. So now what will happen? This investor will be getting cash from two different sources. One will be proceeds from the sale of shares of X Limited, and secondly, it will be from the personal borrowings, both of these cash inflows will be then utilized to purchase as many shares as possible in company Y Limited, and then we will compare the earnings of this investor from company X Limited and from company Y Limited, and then we will decide whether the investor will be better off or not. So the most important thing in MM's arbitrage model is this last part, where personal borrowings will be raised by this investor. So let me take you ahead to show you how should you write the solution further. And here what we do is we make up a calculation of inflows. So amount obtained by sale of shares will be 9,000 shares into the market price per share, that will be rupees 10,800, and to this you add the amount personally borrowed at 6% per annum, that will be 10% of 60,000, and that will be 6,000. Total proceeds will be 16,800. So please write up this working and then I take you ahead. Alright friends, after this working is done, let us move ahead, and now what we do is calculation of total number of shares that the investor can acquire in unlevered company. As per MM's arbitrage model, the entire proceeds obtained on sale of shares of levered company plus amount personally borrowed should be utilized in acquiring the shares of unlevered company. So total proceeds, it is 16,800. Market price of share of Y Limited is rupee 1. So the maximum number of shares that you can acquire at the rate of rupee 1 per share with the proceeds of 16,800 will be 16,800 divided by 1, and that will be 16,800 shares. So please write up this working as well and then I take you ahead. Alright friends, if you have finished writing this whole working, let us move ahead and deal with the last part of the solution. Here we would say calculation of net earnings in the hands of the investor after becoming shareholder of Y Limited. Now the investor holds 16,800 shares in Y Limited. So the total earnings or gross earnings will be 16,800 multiplied by EPS of Y company, that will be 0.12. So 16,800 shares now held in Y Limited multiplied by EPS of Y Limited, total earnings or gross earnings will be 2016. From this gross earnings, this investor, because he has raised personal borrowings of 6,000 at interest rate of 6% per annum, the amount of interest will be 360. In spite of this, the net earnings what you get now is 1,656. Earlier in X company, this investor was earning 1,440. So conclusion will be the net earnings of the investor increases from 1,440 to 1,656. Therefore, it is better to switch over from X Limited to Y Limited. So please write up this whole thing, and that will be end of the solution.